This video is filled with every quality information you need to know about candlesticks chart patterns. Before you start trading them, some of you are familiar with these patterns, but your problem is that you don't know where exactly the market will move to after the formation. You don't know if it will be a reverse or a continuation, and some of you are total beginners, and you don't even have any information about chart patterns at all. But regardless, I will be carrying everyone along in this video, step by step, and by the end of this video, you will see your trading game jump into another level. Now, tribe soldiers, let's get down to business. First off, what are chart patterns? Chart patterns are visual representations of price formations on the chart in order to help traders predict future price movements. It's a combination of candlesticks, price movements on the chart, that actually symbolize something different to us traders. They appear different from the other price movements on the chart, and they can predict either trend reversals or trend continuation. These chart patterns are classified into two different ways, and they add on top of each other, as I will be revealing them steadily as we progress deep into them all. The chart patterns are classified by direction and type. We begin by studying the first classification, which is the direction of the chart pattern. The direction classification relates to the direction that price is supposed to go after the pattern. And since we are talking about price charts, they are only to direction that price can go. It can either go up or go down after the pattern. And when the price pattern implies that the prices will go up after the pattern, we call that pattern a bullish pattern. And when the price pattern suggests that the price will go down after the pattern, we call that pattern a bearish chart pattern. And beyond the direction classification, we also have another classification that add on to the direction classification. This we call the type classification. We have three types of chart patterns. We have the reversal pattern, the continuation pattern, and the neutral pattern. The type of the chart pattern classification tells us what is going to happen with the price on the chart after the chart pattern appear, in relation to what was happening with the price on the chart before the chart pattern was formed. Now, follow carefully as I analyze these three types individually. The reversal chart pattern indicates that price will move in the opposite direction after the chart pattern. They are the trend changers. For example, if the price is going up and a reversal chart pattern appears, it means that the price will go down after the chart pattern. And the opposite also occurs in theism trend changing character. For example, if the price is going down and the reversal pattern appears, it means that the price will go up after the pattern. The continuation chart patterns indicate that the price will continue in its former direction after the chart pattern appears. They are the trend continuation chart patterns. For example, if the price was moving up and a continuation chart pattern appears, it means that the price will continue to go up after the chart pattern. And in the second instance, if the price is going down and the continuation chart pattern appears, it means that the price will continue going down after the chart pattern. And lastly, we have the neutral pattern classification, which means that price can either go up or down after the chart pattern, depending on where price breaks out of the pattern. The way chart patterns are classified is by combining these two types of classification together. For example, when we talk about a bullish reversal chart pattern, we are talking about the pattern that appears when the price is going down, in order to signal a reversal to the upside. That is the case because the term bullish indicates what's going to happen after the pattern formed, which in this case it's going up, and the term reversal means that price will change its direction after the pattern. And if price will change its direction after the pattern and it will go up, it simply means that it was going down before the pattern formed. Another example is in a bearish continuation pattern. Price will be going down before the chart pattern appears, and after the chart pattern appears, the price will also continue going down respecting the former direction. And for the neutral patterns, what was happening before does not actually matter. You simply take a look at which side the price breaks out of the pattern, since that is the direction that it will probably go to. So, if you see a neutral pattern and the price breaks out to the upside, it means that the pattern is indicating that price will go up. And if price breaks to the downside, the chart pattern is indicating that price will go down. As we proceed and enter deeper into these patterns, everything will begin to become more clearer in the flow. Now, tribe soldiers, let's enter deeply into the study of these chart patterns. One by one, we will begin to unravel each pattern in each classification, step by step, starting with the reversal chart patterns. These are the chart patterns that will indicate a change in price direction after the pattern is confirmed. And the first reversal chart pattern we will analyze is the popular head and shoulder patterns. The head and shoulder is a bearish reversal pattern, and it looks like this. And for this pattern, the price will be going up, and after the pattern, it will go down. There are few important elements in a head and shoulder pattern. We have the shoulders, which will be represented by letter A and B. We have the head, which will be represented by letter C, and we also have the neckline, which will be highlighted by the line connecting letter D and E. This chart pattern received its name because the price action resembles the shape of head and shoulders, which is something that makes it easier to remember and detect the pattern in real time. The idea behind the pattern is that price will make a downward turn since failing to produce a higher high at letter B after making a peak at letter C and then going lower, making letter B a lower high. All of this means that the sellers are gaining power as buyers exhaust their energy. The most important part of the head and shoulders chart pattern is there's a neckline. This is the line that will tell you when the price action breaks out of the pattern, therefore confirming the pattern. It is also the line that will tell you when to enter the market. The best way to trade the head and shoulders is by letting the price break below the neckline, then wait for the price to come back, and then retest the neckline. Although some traders are very quick to enter a short trade as soon as the line breaks below the neckline, the problem with that is that you might enter in a much less precise point, so you will end up taking more risk in a smaller potential return. And as I said earlier, the best situation is to wait for price to retrace back up to the neckline. And as price reaches the neckline, it's also important to check for signs that price is indeed respecting the neckline as a resistance. For example, if price comes back to the neckline, and as it reaches it, the price creates some kind of bearish reversal candlestick patterns, we can think about going short on the trade. And this is just one example, of course. There are many other things that can happen when the price comes back to retest the neckline. But in summary, there are only two ways of entering the market when the price comes back to retest the neckline. You can either wait for price to return to the neckline, then you take your trade from there, which is a more risky move, or you wait for the price to break out of the neckline and then come back to retest the neckline. And there you observe how price reacts as it reaches the neckline before taking a short trade. But hey, beware that it is possible that price closes below the neckline and then start to rise again, completely disrespecting the neckline. That's why it is better to enter in the most precise place possible, as it will be less risky. And beyond the entry, you also need a logical stop loss placement and a logical target, and those will depend on the type of entry you choose. The logical stop loss order is above the high of alphabet B, because as price breaks down the neckline, the alphabet B becomes a confirmed supply zone, a point where sellers confirm their power. If you don't know how the supply and demand trading works, check out our trading course on supply and demand trading. This is the safest stop loss to use in a head and shoulder pattern. And now, you can begin to understand why waiting for price to return to the neckline is a better idea, because it will drastically reduce the size of your stop loss. And you can also put your stop loss above the high of letter C. And as your stop loss increases, so your take profit target will have to increase proportionately as well. But hey, the larger the take profit, the lower the chance that it will be hit. The general rule for a take profit target is that it needs to be at least 3 times as big as your stop loss. That means you need to have the discipline to let the price either hit the stop loss or the take profit target. You cannot close the trade as soon as price enters into profits, as this type of indiscipline will ruin your account in the long run. I hear some traders talk about measuring price to create take profit targets. That doesn't make much sense in my view. Another detail about the head and shoulders is that sometimes the neckline might not always be horizontal. Sometimes it can be sloped to the upside or sloped to the downside. You must be careful when that happens, because you want to put your stop loss above the highs. That confirms the power of the sellers, the highs that precedes lower lows. The second reversal chart pattern is the reverse head and shoulders pattern, which works in a similar way to the normal head and shoulder pattern. The reverse head and shoulders is a bullish reversal pattern, while the standard head and shoulders is a bearish reversal pattern. The reverse head and shoulders chart pattern have the same configuration with the standard version, but the pattern is upside down. We have a lower low, followed by a higher low. The logic behind that is that sellers were able to create a low in letter C and also tried to create a low in letter B, but they failed. The pattern is confirmed when the price breaks above the neckline, and as we have already stated, it could be horizontal or sloped, depending on where the previous highs and lows are located. The safer entry happens when the price retraces to the neckline after breaking above it, and the logical stop loss will be placed below letter B, and that happens because as price breaks above the neckline, letter B will become a confirmed demand zone, which will protect our stop loss in most cases. This confirmation of the demand zone may not happen if we are dealing with a reverse head and shoulder that has a down sloppy neckline, which is too steep, and tribe soldiers. The target for the trade must be at least 2 times the size of the stop loss. You must maintain a risk reward like that if you want to survive trading it for a long time. The next reversal chart pattern is also a bullish reversal chart pattern called the double bottom. It is formed by 2 lows that sits on the same price level. It's a bullish reversal pattern, so price will be going down, and then a double bottom will appear to signal a reversal to the upside. The double bottom is confirmed when the breakout line that comes out of letter B is broken to the upside. The logic behind this pattern lies once again in the simple mechanics of highs and lows. On the chart, the double bottom means that they are 2 lows hitting the same price level, and that means that the second low failed to go below the first one. This is a sign that the sellers are getting weak because they were not able to surpass the last level, of which they created by themselves. And if price is able to break above the high in between these 2 lows, it means that buyers are gaining power over the sellers. So not only did the sellers fail to create a lower low, but buyers were able to break the last level where sellers came from. This breakout line is formed only by the high in between 2 lows, so it can only be a horizontal line. The ideal way to trade the double bottom chart pattern is to wait for price to break above the line and come back to retest it as a support. And just like we said previously, as price retraces back to the breakout line, you should observe if price reacts to the line, and if it does, that's the right time to enter a long trade with stop loss below letter A and C, and that's a logical stop loss order, because as price breaks above the line, it confirms the demand zone below letter C. That zone will work as a caution of protection for your stop loss. Doesn't always work, of course, but by using this logic, you can increase your chances of avoiding your stop loss. The target should be at least 3 times as big as your stop loss size. You should not move them at all. You need to wait for the market to either hit your stop loss or hit your take profit target for taking you out of the trade. And just like we have the double bottom as the bullish reversal chart pattern, we also have the double top as a bearish reversal chart pattern. This chart pattern is formed by 2 highs that sits in Thesan price level, and this pattern is a bearish reversal chart pattern meaning that, as the price is going up, the double top pattern appears to change the price direction to the downside. The double top is confirmed when the breakout line that comes out of letter B is broken to the downside. The logic behind this pattern lies once again in the simple mechanics of highs and lows in a chart. The double top means there are two highs hitting the level, and that means that the second high failed to go above the high of the first one. This is a sign of weakness of the buyers, because they were not able to surpass the last level they created themselves. If price is able to break below the low between these two highs, it means that sellers are gaining power over the buyers. But not only did buyers fail to create a higher high, the sellers were able to break the last level where buyers came from. This breakout line is formed only by the low in between two highs, so it can only be a horizontal line. The ideal way to trade a double top chart pattern is to wait for price to break below the line and come back to retest it as a resistance. Just like we said previously for the double bottom, as price retraces back to the breakout line, we should watch and observe if price reacts to the line. And if it does, that's the moment to enter a short trade with a stop loss above letter A and B. That's a logical stop loss order, because as price breaks below the line, it confirms a supply zone at the high of letter B, and that will work as a caution of protection for your stop loss. But hey, it does not always protect your stop loss, of course, but by using this logic, you can increase your chances of avoiding a stop loss. Your take profit target should be at least 3 times the size of your stop loss, and once your take profit target and your stop loss have been set, you should not move them at all. You need to wait for the market to either hit your stop loss or your take profit target. They are traders that don't wait for price to retrace back to the breakout line, but as we have said before, this can be a little bit riskier, because your stop loss size will be bigger, as you are entering in a much riskier position. Traders do this based on the fear of missing out, popularly known as FOMO, so they sacrifice their entry a little bit, and sometimes a lot, just to be part of the trade. But hey, if you continue acting like that on the long run, it will be very bad for the growth of your account. The next chart pattern we are going to study is more like the extension of the double bottom chart pattern, and it's called the triple bottom. It's a bullish reversal chart pattern, meaning that price will be going down, then it will appear to signal a reversal to the upside. I said it is an extension of the double bottom because it is very similar to the double bottom chart pattern, but instead of 2 lows sitting at the same level, the triple bottom has 3 lows sitting at the same price level. In other words, the lows A, B, and C form a great support, which means that sellers are trying to create lower lows, but they are failing to do so. Meanwhile, the buyers are gaining power and momentum to break out to the upside. One of the things that we see in a triple bottom, but we don't see in a double bottom, is the fact that now the breakout line or neckline now has 2 axes, and sometimes these lines can be sloped instead of horizontal. It all depends on what will happen when you connect high D and E to form the necklines or the breakout line. The way to trade this chart pattern is the same as before. The neckline, a trader should wait for a breakout to the upside of the neckline and the retracement to the neckline, which is now acting as a support. The stop loss should be below letter A, B, and C, and the take profit target should be at least 3 times the size of the stop loss. Though some traders teach that your take profit target should be roughly the same size with your stop loss, but unfortunately, that will not be enough to produce good results for the long term due to the chaotic nature of the market. Remember that these patterns are far from being perfect and may fail sometimes, so you need to compensate that by using smart risk management, which in this case means using a take profit target that is a few times more than the size of the stop loss, and let the market reveal itself to you. And just like the triple bottom is an extension of the double bottom, the triple top is an extension of the double top. The triple top is a bearish reversal pattern, meaning that price will be going up, and the triple top will appear to signal a reversal to the downside. I said it is an extension of the double top because it is very similar to that pattern, and instead of two highs sitting at the same price level, the triple top has three highs sitting at the same price level. In other words, highs A, B and C from a nice resistance, which means that buyers are trying to create higher highs, but they are failing to do so. Meanwhile, sellers are gaining power to break out to the downside. And an extra detail that we see in the triple top, but we don't see in a double top, is the fact that the breakout line or the neckline now has two axes or two lows, though sometimes the lines can be sloped instead of horizontal, but it all depends on what will happen when you connect lows D and E to form the neckline or breakout line. The way to actually trade the triple top pattern is the same as before. The traders should wait for a breakout to the downside of the breakout line and a retracement to the line acting as resistance now as the ideal scenario, and the stop loss should be above highs A, B and C, and the take profit target should be 3 times the size of the stop loss. And normally people teach that the take profit targets should be a measure movement. That means that the take profit targets should be roughly the same size with the stop loss. But unfortunately, that is not good enough to produce great results in the long run due to the chaotic nature of the market. And remember that these patterns are far from being perfect, and they will fail sometimes, so you need to compensate that by using smart risk management, which in this case means using a take profit target that is a few times bigger than the stop loss and letting the market reveal itself to you. So far, I've discussed the head and shoulders pattern, the double and triple tops and bottoms, as part of the reversal category. Now, let's move into the wedges, another broad reversal patterns, and we will be starting with the falling wedge. The falling wedge is a bullish reversal pattern, meaning that price will be going down, then a falling wedge will appear to signal a reversal to the upside. The wedge moves in series of contracting price movements. If we connect the highs and the lows, we observe that the two lines converge with each other. The logic behind the falling wedge is that at each price movement, the sellers are losing power. That's why the wedge is progressively narrower, and the selling power is too low, that buyers make the price break out to the upside. And using the same logic as before, the ideal entry happens when the price retraces back to the upper line of the falling wedge to test it as support. The logical stop loss is placed below the lowest low in the wedge, and the take profit target should be placed at least 3 times the size of the stop loss. We also have the rising wedge, which is a bearish reversal pattern, meaning that price will be going up. Then the rising wedge will appear to signal a reversal to the downside. The wedge is in series of contrasting price movements. If we connect the highs and lows, we will observe that the two lines tends to converge with each other. The logic behind the rising wedge is that, with each price movement, the buyers are losing power. That's why the prices are progressively narrower. And since the buying power is too low, the sellers make the price break out of the wedge to the downside, and using the same logic as before, the ideal entry happens when prices retraces back to the lower line of the rising wedge to test it as resistance. The logical stop loss is above the highest high of the wedge, and you should strive for a take profit target that is at least 3 times the size of the stop loss. To finalize the reverse chart patterns, I will show you another category known as the expanding triangles. The bullish expanding triangle is a bullish reversal chart pattern, meaning that price will be going down, then the expanding triangle will appear to signal a reversal to the upside. This chart pattern received its name because it describes a series of expanding price movements or a progressive increase in volatility. The logic behind this chart pattern as a reversal pattern is that the current market player is finalizing by producing pronounced final drives. In the case of a bullish expanding triangles, the current players are the sellers, since price is going down, so they will produce progressively larger movements to finalize their trend, and after that, buyers will pick it up, and price will reverse direction. Notice how that is different from the wedge, where the current market player is losing power. The way to trade the bullish expanding triangles is to wait for price to break above the upper line, and then wait for it to retrace to the line to test it as support. The stop loss should be below the lowest point of the triangle, and the take profit target should be at least 3 times the size of the stop loss. And next we also have the bearish expanding triangle, which is a bearish reversal pattern, meaning that price will be going up, and then a bearish expanding triangle will appear to signal a reversal to the downside. This chart pattern received its name because it describes a series of expanding price movements or a progressive increase in volatility. The logic behind this pattern as a reversal signal is that the current market player is finalizing the trend by producing pronounced final market drive. In the case of a bearish expanding triangle, the current market player are the buyers, since price is going up, so they will produce progressively larger price movements to finalize the trend, and after that, sellers will resume and price will reverse direction. Notice how that is different than the wedge, where the current market player is losing power. The way to trade the bearish expanding triangle is to wait for price to break below the lower line, and then wait for it to retrace back to the line to test it as resistance. The stop loss should be placed above the highest high of the chart pattern, and the take profit target should be at least 3 times as large as the size of the stop loss. And there we have it for the reversal chart patterns. Now, we will move into the continuation patterns. And we will start with probably the simplest continuation patterns, which is called the rectangle chart pattern. The rectangular chart pattern consists of the bearish and the bullish rectangle. We will first begin with the bullish rectangle. Remember, now we are talking about continuation chart patterns, so it signals that price will resume its current direction after the pattern is confirmed. The rectangle happens when price begins to oscillate sideways, and the highs and lows are moving in horizontal lines that will make the pattern take the shape of a rectangle. And that's where the pattern name came from. The logic behind the rectangular chart pattern as a continuation pattern is that price has been trending for a while, and now there is a consolidation bound to happen. Since the market cannot keep rising or falling forever, if you're a beginner, you will always notice that price is always oscillating between these two modes. It's either it's trending or moving sideways. I'm obviously oversimplifying this for the purpose of this video. This is a valid perspective, and the best way to trade the bullish rectangular chart pattern is to wait for price to break above the lines that connect the highs and to retrace back to that line to test it as support. This is actually our target expectation, but it does not happen like this always. Sometimes price breaks the line and just keep going, and this can be a problem because if you are an anxious trader that likes to chase the price, once it breaks a pattern, it can end up badly for you. The stop loss is placed below the lowest point of the rectangle, because as price breaks the upper line to the upside, it can easily confirm a demand zone at the low of the rectangle. So you can count on the help of those buyers to protect your stop loss order. Your take profit target should be at least 3 times the size of your stop loss. Remember that the continuation pattern implies that price is trending, so you can as well leverage on that. It's also important to remember that there can be more highs and lows contained inside the rectangle. Now, on the bearish side, we have the bearish rectangular chart pattern, which happens when price is going down, and when the pattern is confirmed, the price will continue going down afterwards. The logic behind the bearish rectangle and the way they trade is the same as the bullish rectangle, of course. The only thing that is changing is the side you are looking to trade. As price breaks the low of the line connecting the rectangle, it retraces back to this line to retest it as resistance. then that is a perfect opportunity to open a trade and place your stop loss above the rectangular box, connecting the pattern, because by the time price breaks below the rectangle, it usually confirms a supply zone around the high of the rectangle. One of the problems you'll find with this simple chart pattern is that price will sometimes retrace much deeper and closer into the box. So if you are a kind of trader that always enter a trade immediately it breaks out, it can be very risky for your account, as price sometimes can break out and move very deep into the box, clearing your stop loss. So it is best to wait for price to break out and then retrace to the line, giving you a clear bearish candlestick signal. And if you want to learn more about candlestick entry signals that we use to trade chart patterns and other trading strategies, watch this video right now. The next chart pattern that we are going to study is called the flags pattern. It is similar to the rectangle in some ways, but it has some few extra twists. Starting with the bullish flag first, imagine that you take a bullish rectangle and rotate it in a way that both lines becomes down sloppy. The pattern received its name because it is supposed to resemble the shape of a flag, the trending part of the price being the pole and the continuation being the flag, a simple analogy that can be used in recognizing the chart pattern in a more visual way. The confirmation for the bullish flag happens when price breaks above the upper down slope line and then retraces back to it to test it as a support. One advantage of the flag pattern over the rest is that since we are dealing with a down sloped breakout line, price needs to retrace deeper in order to signal a trade. That means your entry will be closer to your stop loss, and therefore you will be able to take a less risk on your positions. Your stop loss should be below the lowest low in the flag, and your take profit target should be at least 3 times bigger than the size of the stop loss. The bearish flag pattern is exactly the opposite of the bullish flag pattern. So imagine that you take a rectangle and rotate it in a way that both lines becomes upsloped. The confirmation for the bearish flag happens when price breaks below the lower upslope line, then retraces back to test it as resistance. The advantage of the flag over the rectangle is that, since we are dealing with an upsloppy breakout line, price needs to retrace deeper in order to signal a trade. That means your entry will be closer to your stop loss, therefore you take a less risk. Your stop loss should be above the highest high of the flag, and your take profit target should be at least 3 times as big as the stop loss. The next pattern we are going to study is actually very simple and exactly the same shape for the bullish and the bearish variations. The pattern is called pennants. Let's start with the bullish pennants. The pennants consists of 2 lines that converges to each other as prices moves in between them. But although we already saw chart patterns that have lines converging to each other in the reversal patterns, but in those patterns price was trending, but in the pennants pattern the prices are going sideways. So you can imagine a horizontal line that describes the angles of the pennants. Another characteristics of pennants that differentiate them from other chart patterns, like the symmetrical triangles for example, is the fact that they are formed by small price movements in the middle of a powerful trend. And once again, the only difference between a bullish pennant and a bearish pennant is the direction of the price before and after the pattern. In a bullish pennant, the price will be going up, then the pennant will appear to signal a continuation of the trend. Once price breaks above the upper line and retrace back to the upper line to test it as a support, a buy signal is generated with a stop loss below the lowest point of the pennant and a take profit target at least 3 times as big as the size of the stop loss. For the bearish pennant, price will be going down and the pennant will appear once price breaks below the lower line and then retraces to the lower line to test it as a resistance. A sell signal is generated with a stop loss above the highest point of the pennant, and the take profit target will be at least 3 times as big as the size of the stop loss. And next we have a slightly more detailed set of continuation patterns, which are the triangles. This pattern can be divided into symmetrical, ascending, and descending triangles. And some of them have bullish or only bearish variations. Let's begin with the symmetrical triangles. A symmetrical triangle is a bit similar to the pennants. The only real significant difference is that the symmetrical triangle seems to be larger, and pennants seems to be smaller in size. Apart from that, they are indeed very similar. The symmetrical triangle have two lines converging to each other symmetrically, so the upper line is down sloppy, and the lower line is up sloppy. They have mirroring angles. This chart pattern has a bullish variation, where price will be going up, and the symmetrical triangle will appear to continue the trend. The buy signal happens when price breaks out of the triangle to the upside, then retraces back to the upper line to test it as a support. The logical stop loss is placed below the lowest low of the triangle, and the take profit target is placed at least 3 times the size of the stop loss. In the bearish variation, the price will be going down, then the symmetrical triangle will appear to signal a continuation of the trend to the downside. The sell signal occurs when price breaks out of the triangle to the downside, then retraces back to the lower line to test it as resistance. The logical stop loss is placed above the highest high of the triangle or above a confirmed supply zone, and the take profit target is at least 3 times the size of the stop loss. The next pattern is the ascending triangle, which only has a bullish variation. The difference between a symmetrical triangle and the ascending triangle is that in the ladder, the highs form a horizontal line and the lows form an up sloppy line. This signifies the eminence of the bullish market by the creation of high and lows. The buy signal happens when price breaks the upper line to the upside and retraces back to it to test it as support. The logical stop loss can be below the lowest low of the triangle as the standard, or below a confirmed supply zone, and the take profit target should be placed at least 3 times as big as your stop loss. The other pattern that finishes the continuation triangles is the descending triangles, which only has a bearish variation. In the descending triangle, the upper line is down sloppy, and the lower line is horizontal. The progressive creation of lower highs signifies the imminence of a bearish market. That's why a descending triangle is a bearish continuation pattern. The sell signal happens when price breaks below the lower line to the downside and retraces back to it to test it as resistance. Your stop loss can be above the highest high of the triangle for the standard or above a confirmed supply zone, and the take profit target at least 3 times as big as the size of the stop loss. To finish off the continuation patterns, we have the cup and handle pattern, which has a bullish and a bearish variation. Let's begin with the bullish variation first. The cup and handle is formed by 2 convex arcs, one large arc, followed by a small arc, but the high seems to be hitting a resistance wall. The 2 arcs, in alignment, makes the price pattern visually resemble a cup and handle, which gives it the name for the pattern. The fact that the handle or the smaller arc retraced just a little bit and then hit that resistance wall again signifies bullish power, and when the price breaks the resistance and retraces back to the line to retest it as support, then we have a buy signal. The logical stop loss should be placed below the lowest point of the handle, and the take profit target should be at least 3 times as large as the size of the stop loss. The bearish variation of the cup and handle is called the reverse cup and handle pattern. It looks like a cup upside down. In other words, we have a price formation composed by 2 concave arcs, one large and one small. The lows of this arc seems to be hitting a strong support. So when price finally breaks this support and then retraces back to test it as resistance, then we have a sell signal. The stop loss should be placed above the highest high of the handle or the small arc, and the take profit target should be at least 3 times the size of the stop loss. This finished the continuation patterns. Now we will move on to the final section, where we will talk about the neutral patterns. The thing about neutral pattern is that price could be going up or down before the pattern, and it can go up or down after the pattern. So the key thing to look out for is the direction that price breaks out of the pattern. Where price was going before the pattern doesn't seem to be that important when we are talking about neutral patterns. The neutral patterns are composed by 4 types of triangles. Let's begin by the ascending and descending triangles first. The ascending triangle, as we saw earlier, can be either a bullish continuation pattern, meaning that price will be going up. Then the ascending triangle open from a continuation to the upside. Or the ascending triangle can be a neutral pattern. This means the direction that the market was going before the pattern is irrelevant. What matters is the breakout direction that confirms the ascending triangle. If price breaks the upper line of the ascending triangle, it means that price is probably going to the upside. And if it breaks the lower line of the triangle, it means that the price is probably going to the downside. The way to trade either direction is the same as all other chart patterns we saw. We wait for a breakout and then wait for price to retrace to the breakout line or neckline, and in the case that price breaks out to the upside, the stop loss should be placed below a confirmed demand zone, and the target should be at least 3 times the size of the stop loss. And in case that price breaks the pattern to the downside, the stop loss should be placed at a confirmed supply zone, which in this case is the upper horizontal line. And in the case of a descending triangle, we have the exact same situation. The only difference is that the upper line of the triangle is downslopey, and the lower line of the triangle is horizontal. And once again, since this is a neutral pattern, the trader must pay attention to where price breaks the pattern. If it breaks to the upside, your stop loss should be below the lower horizontal line, with the take profit target at least 3 times as big as the stop loss. And if price breaks the pattern to the downside, your stop loss should be above a confirmed supply zone, and the take profit target should be at least 3 times as big as the size of the stop loss. Following the same steps and process once again, we have 2 other types of triangles that finish the category of neutral chart patterns. We have the symmetrical contrasting triangles and the symmetrical expanding triangles. The only thing that changes between these neutral chart patterns is the angle of the upper and lower lines. Beginning with the symmetrical contracting triangles, we have upper lines and lower lines that converges to each other. So this pattern implies a decrease in volatility. If price breaks above the triangle, the stop loss should be placed below the lowest low of the triangle, or in a confirmed demand zone. And if price breaks to the downside, the stop loss should be placed above the highest high of the triangle, or in a confirmed supply zone. The take profit target should always be placed at least 3 times as big as the size of the stop loss, if you want to use this consistently in the long term. The second triangle is called the symmetrical expanding triangles. This one implies an increase in volatility, and they can be quite challenging to trade. If price breaks out of the pattern to the upside, the stop loss should be below the lowest low of the pattern, or below a confirmed demand zone. And if price breaks below the pattern to the downside, the stop loss should be above the highest high of the pattern, or above a confirmed supply zone. The take profit target in all situations should be at least 3 times as big as the size of the stop loss. This finishes off the exposition of the most relevant chart patterns for trading. We can notice that there are a few things that repeat across all patterns. The first thing relates to the proper way of trading these patterns, which is to wait for price to break out of the pattern, and then wait for price to retrace and test the line as support or resistance, depending on which side of the line that we are talking about. When it comes to chart patterns, this is the best moment to enter the trade. However, price doesn't always retrace to the breakout line or neckline to give you the opportunity to enter a trade. Sometimes price will break the pattern and keep going. And this is a problem, because the more anxious traders will try to chase prices without waiting for it to retrace to the proper entry points. This is part of the need for action and part of the fear of missing opportunities. The problem, however, is that if traders keep chasing price like that, he will need to increase the distance between the entry point and the correct stop loss placement, and that implies that the target take profit target must be much larger. That's if the trader wants to respect the correct risk management guideline, which he or she definitely should. Another way of thinking about this is that if you don't wait for the correct entry point to occur, which doesn't always happen, you will be taking more risk than what is necessary, and your trade will have a lower probability of hitting the target. Some traders will try to bypass this problem by altering the stop loss placement, which is a very dangerous idea. If you change the correct stop loss placement because you want to reduce your risk, you will end up increasing your risk at the end. Because if you place your stop loss at the wrong place, you will not have the extra protection of the buyers and sellers in the proper zone, so you will decrease your stop loss size, and at the same time, you will increase the probability that the stop loss gets triggered. All of this means that if you want to use chart patterns for trading, you will need to have the discipline to wait for the proper entry signal to appear, meaning that sometimes you will need to see patterns developing in front of you, and you will need the discipline to let price go without trading, because the proper entry signal did not happen, and all this are part of the psychology games that you need to master to trade these patterns sufficiently. So in summary, if you want to trade the chart pattern the right way, number 1, you wait for the price to break out of the pattern. 2, you wait for price to retrace back to the breakout line. 3, you observe if price still respects the breakout line. And 4, you open the trade with the proper risk management plans. And just like every other trading strategy in the market, the chart pattern is not guaranteed to work all the time. But if you follow these laid out processes, you will find yourself winning a lot of your trades using chart patterns, just as I have simplified in this video. And if you notice, in number 3, it states that you must observe how price reacts when it retraces to the breakout line. And the only way to understand that is by studying candlestick patterns. This will help us to get the best entry spots to trade the chart patterns. And in this video I taught about all the candlesticks patterns in the entire trading market that you need to know to begin to make great entry decisions as you trade. And if you want to learn trading personally with me, use the link in the description box below. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.